After months of speculation, the Chancellor has announced the most leaked budget in history. They even had the embarrassment of the OBR releasing all the details of the budget prior to Rachel Reeves even standing up in the Commons. But I've sat through the whole circus, cut out the boring parts to give you the key stuff that you need to know. Let's start with the main theme. In the last budget, there was around £40 billion in tax rises. This budget, just a mere 26 billion. And according to the OBR, that now takes the total tax take to an all-time high of 38% of GDP by 2030-31. What we didn't get is any changes to the big three, income tax, national insurance or VAT. But what we did get is a plethora of smaller tax rises, some more stealthy than others. Let's start with the biggest one, fiscal drag. This one's pretty stealthy because people don't see a direct increase in the tax rate that they pay. But what will happen is as wages increase over time, because thresholds are being frozen for another 3 years, over that period of time, they'll pay more in income tax and national insurance. All three thresholds are going to be frozen for income tax. That's the personal allowance, the higher rate, and the additional rate bands. And this is expected to raise around £8 billion over the course of this parliament. This was a policy introduced in the last government, but this government has decided to carry on those freezes. And in a way, it's an easy way to tax a large majority of people, most of the population, because you're not directly increasing the income tax rate. There was rumours before this budget that the basic rate of income tax was going to increase from 20% to 21 or 22%. But that would have been political suicide because they made it very clear in the manifesto that they weren't going to increase taxes on working people, i.e. increase income tax, VAT or national insurance. They already found a loophole in the last budget where instead of increasing national insurance on employees, they increased on employers. And that has to be one of the worst tax policies in living memory, increasing the cost of businesses. And we've all seen the impact of that over the past year. We've seen an increase in unemployment, we've seen an increase in inflation. And that's because businesses have got more costs. They're going to pass that on to either the consumer or the employee. So in a cost of living crisis, those working people are going to pay more in the shops because inflation is going up, because companies are passing on that cost. And they're also going to see their wages not increase as much because companies have got less to pay them with. And now in this budget, the thresholds are being frozen for another 3 years, which continues to push more and more people into a higher rate of tax. Just for comparison, in the year 2000, about 7% of the working population paid higher rate tax. Today, that figure's around 21% and only set to continue to go higher. If the higher rate threshold was increased in line with inflation, it would now be sitting around 75,000 as opposed to the 50k that it's frozen at right now. The next biggest contributor to these tax rises is salary sacrifice, and this affects about 1/3 of private pensions. The contributions into these types of pensions are going to be capped at £2,000 per year. And one of the biggest benefits of contributing into a pension via salary sacrifice is that it comes out prior to you being taxed, i.e. it reduces your taxable income. That means you save both income tax and national insurance. And now this is being capped at £2,000. It means anything that you contribute more than that, you'll still get the income tax relief, but you won't get the national insurance tax relief. It does now mean that these are slightly more in line with other types of pension contributions, which only get the income tax relief. And I do think this is another stealthy one that has come slightly by surprise, not only because the amount that's going to be raised, £4.7 billion by the end of the parliament, but also because I think a lot of people won't realise the type of pension that they're in. And they've been paying into a pension, and now all of a sudden they're going to get a 2% less contribution into that pension. In a time where we've been warned about pensioner poverty and saving for retirement, how expensive it's going to be. Of course, this is designed to affect the most wealthy in society who earn the massive salaries. And if they get a big bonus, for example, they can put that all into a pension via salary sacrifice and get massive tax relief. But it's also going to affect your average worker as well, which is again another tax on working people. Then we've got tax increases on dividends, property income and savings of 2%, and this is expected to raise about 2.1 billion by the end of the parliament. These are not due to come into effect until April 2027, so you've got a bit of time yet. And I think the increase to dividends, although it's not ideal, I think is a slightly easier pill to swallow than the increases to property income and savings. Dividends for a long period of time have had a lower tax rate than your typical income tax rates. So it's made it easy that if you have a business, rather than paying yourself a salary, you'd pay yourself a dividend because you'd pay a slightly lower rate in tax. So an increase of these of 2%, while not ideal, I don't think it's too bad in the grand scheme of what else we've got here. But what I do think is really mad is increases to both property income and savings. Because what it means now is that type of income is now at a higher rate than your typical income tax bands. For example, the basic goes to 22%, the higher goes to 42%, and the additional goes to 47%. And although you look at property income and think, oh, that's just greedy landlords who have got loads of property, they can afford to pay more, who do you think they're going to pass that cost on to? In a cost of living crisis, that's just going to mean rents are going to go up even more than they already have done. And that increase in savings income is also quite stealthy because at the same time we've had changes to ISA allowances. You've still got the same cap of £20,000, so you can put 20k into a stocks and shares ISA, but the amount that you can contribute to a cash ISA is being limited to just 12k. And if you want to save any cash over that allowance, you're then going to be taxed on that difference. The idea here is that they want to encourage people to invest into the stock market, not only to get better returns long term, but also want to try and contribute towards British businesses. It's almost the right idea, but the wrong execution. I honestly don't think the changes to ISA allowances are actually going to make that much difference at all. You can still put 12k into a cash ISA, £1,000 per month. And if you do want to put more in per month, you can just hold cash in a stocks and shares ISA. Because, for example, say that you were coming up to buy a house purchase and you had your money in the stock market and you want to sell those investments because you want to protect the capital, reduce your volatility. Before, you could have moved that into a cash ISA. Now it's just slightly different where you'll use a bit of a loophole where you won't move it to a cash ISA, you'll just hold cash in your stocks and shares ISA. You can still get a return on it as well. And I don't think people who then want to save more than that 12k per year will suddenly go, I'm going to invest into the stock market now. That wasn't the issue before. It's more down to a lack of education, training, confidence into the stock market. And we've all got our part to play here. And hopefully I'm helping with this style of content on this channel, and many other creators on YouTube and in the media can help with that. And I think that's where more focus has to be. But I think people just look at other options. You can still put 50k into premium bonds. That might be a temporary solution. But really it comes down to encouraging the public to invest long-term into the stock market rather than holding cash. And I think a way of forcing them to reduce the amount that they can put into a cash ISA is not the right way. I think the idea of investing into British businesses is a good idea on paper, but I think this won't happen even if people invest into the stock market. The UK makes up such a small percentage of the global stock market. We're not going to really see the benefit there. I think if you really wanted to drive growth in British businesses, you'd have to give people another, say, 5k tax allowance. You'd have a 25k total, but 5k had to go into British firms. That way, not forcing people to put any extra money that they would have had already in the ISA allowances, but it means you might get an extra amount that people might start to invest into British firms, which could be a good benefactor. We're not going to see that. And then we've got an EV tax. And I think something like this was always going to come in at some point because of the amount of revenue raised from fuel duty. When people start switching more to electric, then obviously that reduces that revenue. So they've got to try and get it from elsewhere. And the idea here is that they're going to charge people on a per mile basis, which seems crazy. And I've no idea, and there's no details of how exactly they're going to collect that data. But they're going to charge people 3p per mile. We'll have to see how that one turns out, but is expected to raise about £1.4 billion. Then we've got changes to the minimum wage, and this is increasing for over 21s to £12.71. That's an increase of 4.1%. And we're also getting an increase for workers aged 18 to 20 to £10.85, and that's an increase of 8.5%. And I don't think this one's going to go down well at all. Not because I don't think younger workers and people on low incomes should earn more, especially in a cost of living crisis. But I think there's other ways to do it that are fairer, especially on a squeezed middle. But it's also another cost to businesses. That's going to lead to either an increase in unemployment because businesses just physically can't afford to employ those member of staff because it's more expensive now. Or they're going to pass it on to their other employees, which means that people in the middle are not going to get the pay rise that they expected, or they get a smaller increase. Or they'll pass that cost on to the consumer, which again is then inflationary. I think they think when they increase the minimum wage that everyone just above that also increases at the same time. But say, for example, you've got someone who's worked in industry for a good few years, they've built up some experience, maybe they've got some qualifications, and that then means that they have moved their way up and they earn a little bit more, say 15 to £20 per hour. When the minimum wage goes up by 4.1%, for example, for over 21s, it doesn't mean that they automatically get it. They would probably just stay on that £15 per hour because the company can't afford to increase that. They're only doing the minimum wage because they have to. So then what you end up with is someone with loads of experience, really good qualifications. They get stuck in that middle role. And then you've got people who are coming in with absolutely no experience, never worked in the industry whatsoever, are coming in at only a little bit less than what someone who could have 10 years experience has. And the government has many options it can use to increase the living standards for lower earners. The biggest one, and we've touched on thresholds already, is the personal allowance. If that had increased in line with inflation, that would be up around £17,000 right now. But still it's stuck at 12.5k. But of course, if they increase the personal allowance, that's potentially less tax revenue in the short term at least. So instead they went, rather than reducing tax revenue there, we're going to just put it to the businesses and they can pay for it. Again, another tax on businesses. If you did increase their personal allowance instead of increasing the minimum wage, yes, that might reduce tax revenue slightly in the short term. But actually, if you avoid unemployment increasing, more people can afford to work, businesses can afford to employ more people. That business might make more money, make more profits. They're going to pay that in corporation taxes. They can afford to give their workers pay rises. They're going to pay that in income taxes. They're not thinking about the bigger picture whatsoever. They're just thinking about quick wins, what might go down well with the voting public. Just give them a quick increase to the minimum wage, even if it's above inflation. Forget about the squeeze middle. That's just an easy one, right? I think they've got this completely wrong. In the run-up to this budget, there were massive calls for some form of wealth tax, either a new tax or reforms to existing wealth taxes. We didn't really get anything substantial in that aspect. What the closest thing we did get is a mansion tax. And this is going to be an annual levy on properties worth more than £2 million. It's going to be done via council tax, and it's going to be a surcharge on top of what they already pay. There's going to be a tiered rate from 2 million to 5 million, with houses just over 2 million paying an extra £2,500. And then properties worth over £5 million paying £7,500. This one's okay, but I think they just didn't go far enough in all honesty. I think they actually bottled it. I think they're trying to dip their toe in the water, see how this lands, and then make changes going forward. I think what most likely will happen is they'll keep their thresholds the same. So you pay above £2 million, and as house prices continue to increase in the future, more and more people will get pushed into that rate. But there's still no council tax reform. It's still a massively outdated system. And you're still comparing a house that's 5 million to 50 million, still paying the same amount of council tax. I think if people want to park money in property in the UK, they should have to pay for that privilege. And on a £5 million plus house, paying 7.5k per year, that's nothing to them. And this tax doesn't even make that much money. It's predicted to make about 400 million by the end of the parliament. And the OBR actually suggests it's going to lose money in the short term, because what they expect to happen is that owners and sellers will start bunching below the thresholds, which is going to cap the increase in property prices, which then means less revenue from stamp duty and from capital gains tax. And now you've got the worst of both worlds, because not only are you still going to annoy people by adding this levy, you haven't reformed the rest of council tax, and it's not even raising that much money. The biggest thing this government needs to do is to stimulate growth in the economy. That is the only way out of this mess. What they're doing is what's being called a spreadsheet budget, where they're simply just looking at tax receipts and spending, and they're just trying to balance the numbers. They're not thinking about the bigger picture. They're thinking about how they can survive this parliament, how they can get through the next few years and win the next election. They say they're making difficult decisions, but they're not doing the reform that's necessary. Economic growth is just going to go lower and lower, which means we're going to get less tax receipts. And mark my word, this time next year, it's going to be like deja vu. It's going to be third time round, coming from more tax increases, because these increases haven't raised the amount of tax revenue that they expect. The economy has grown slower than expected, and spending hasn't been cut where it's necessary. So what's going to happen next time is that they'll have to break their manifesto pledge, and they'll probably increase income tax to 21 or 22%. Unless they stop the rampage of businesses just thinking that's free money, increasing employers' national insurance, increasing the minimum wage, thinking that's just free money that businesses can just afford to pay, and then wondering why food inflation can't get below 5%, wondering why people are struggling to pay their rent and mortgages, and cost of living crisis is what it is now right now. This thing is so anti-growth and pro-inflation, it's baffling. The OBR predict growth in real household income is predicted to fall significantly from 3% in 24-25 to around 0.25% a year over this forecast. If this government was a manager or a CEO of a company, they would have been sacked months ago. But yet, here we are. I want to end on more of a positive note. And the one thing I think we can take now is, from months and months of speculation of what might or might not happen, I think it's been unprecedented the amount of leaks that have come out before this budget. There's been so much talk and so much debate. At least, as bad as it might seem, at least we know what we're working with now, and we can try to move forward. And you also can't control it. You can't control what the government does. All you can control is what you do as a person. Whether that's work on your business, get new qualifications to get that next pay rise, working on the next big thing. That's all you can control. We can complain all we like, we can protest, we can shout and all the rest of it. But what you can really control is how you move forward in your own personal life. I know that's easier for some people than others, but the best thing you can do is not to rely on other people, not to expect any handouts, and see how you can move forward yourself. Let me know your thoughts down below in the comments, and I've got a more light-hearted video coming on Sunday. Thanks for watching.